In this episode, I'm joined by Dan Proctor, who is the Director of Finance at Future Leap. Welcome to the episode, Dan.
Hi, absolute pleasure to be here.
Now, this is hopefully going to be very, very timely for everybody listening because I know, because I talk to a lot of people and I hear and feel the pain of lots of people who don't really understand how to take maybe some of the next steps in some of their green, eco, sustainability, carbon, whatever you want to call it, initiatives. And I think one of the big blockers that they're finding is the whole question of financing. How do you go about this thing if you're looking at a sustainability project? How do you begin? Who do you contact? Because if I'm right, Dan, the old models of financing in lots of ways don't actually apply anymore to this kind of brave new world that we're all trying to forge. Would I be right?
Yes and no. I think that access to finance has been one of the biggest blockers for the SME community in terms of going on those sustainability journeys, and there's various reasons for that. And my background is over 25 years in the leasing and asset finance industry, and there's lots of learnings that we can take from the technology sector and the way in which the technology sector has engaged in those finance journeys. And this may be a little off tangent, so I apologise. But we have captive lessors within the tech world, the IBM Global Finances and the Hewlett Packard Enterprise Financial Services. So those tech giants have established their own funding operations specifically to be able to get their technology to market. And there has been a huge industry around business finance and tech finance and helping companies to invest. But that doesn't seem to correlate to the attitudes and the way in which finance is working within the sustainability sector in particular. And we have found that the tools that are readily available, particularly for those retrofit suppliers or clean tech companies or green tech companies, the way in which they want to take their products to market, they're not engaging with the commercial models which have proved very successful in other markets. And so the lack of the supply chain being able to bring, what is the traditional sales aid models to the market to help their customers has an impact. We do have some residual hangovers from the challenges with solar installations back in the sort of early teens, I think it was, and there was some significant baths taken by the banks in terms of huge losses, hundreds of £1 million worth of losses on these solar projects where they found the contracts unenforceable. So we have had the business lenders perhaps viewing sustainability investments through the wrong lens and viewing it as higher risk and more high risk than it should be. And so yes, it is some of those challenges, particularly around accessing grant funding. Grant funding has been a key tool for the SME to embark upon their carbon reduction journey. But we all know that government funding is never going to be enough. And so, and also grant funding through our own experience at Future Leap, mixing that together with match funding. And so we start looking at leasing and asset finance as vehicles to be able to support that match funding, and it doesn't fit. And so therefore the SMEs aren't being offered the right options. There are business lenders who have an element of nervousness around the assets involved in these sustainability projects. And then the financial vehicles which have been used haven't been fit for purpose when it comes to looking at supporting the grant funding which is available, the government funding which is available. So yeah, there are certainly challenges, but no challenge which can't be overcome.
Yeah, I mean, There's many similarities I'm feeling just listening to you talk there between, the finance kind of uncertainties and risk, and certainly from, in the world that I operate in particularly in marketing, with a lot of marketers looking to do either green eco initiatives within their organizations, or they're in that kind of a sector, or they're maybe a startup and they're looking to kind of bring something to market from a marketing perspective. It's the fact there's no real kind of well-established playbook, and what we're trying to do here, I think, probably as marketing industry, is we're looking to kind of write it as we go, hopefully not make too many mistakes as we go, not to be too painful. It feels like there's quite a few similarities here from the finance perspective, because it's a new model, isn't it? Really, it's just a new way of thinking, and where some of the old paradigms of finance stroke marketing, I mean, yeah, some of the logical kind of strategic, big old established models, they still apply, but most of the stuff is really starting from scratch, isn't it?
It is, yeah. I think there are a combination of factors, as there is no standard, and so for sustainability engagements, whether it's from a marketing perspective, whether it's from a carbon measurement perspective, we're looking at the scope 1, 2s, and 3s. The UN sustainability goals are still the key standard that people are working for. So there is no playbook. There is no accepted standards in terms of taking these things to market. And so, yeah, I mean, we did some research on the number of environmental consultants in the UK, and based on the SIC code, the Companies House, there's now over 10,000 environmental consultancy companies, which is a huge number. and there is, and if we look now at the opportunities which are available online from software platforms, some of them free, some of them to be paid for in terms of the measurement of the carbon emissions in the scope 1s, 2s, and 3s. Again, there's so much assumption which is taking place. We looked at so we're really driven from a fintech perspective, looking at how automated decisioning can support the financial world. Previously, we've developed 2 different fintech platforms, but we want to take that experience and empower the business lenders to start making automated decisioning with reference to the sustainability impact of the lending or the investments they're making. And when you start to have a look at the data that's available there, again, it's so in its infancy at the moment. I mean, Experian have got solutions which are based upon the those carbon emission factors from the Office of National Statistics and the SIC codes. Now, if I speak to our lead consultants here, we know that's fraught with danger, and those guesstimates can sometimes do more harm than good. Dun & Bradstreet have got their own sort of ESG data which is available, but it's for 10% of companies, and it's an opt-in, and so again, how where there is a fresh start, and the accepted principles that we have. So I'm going back to the finance world, which is where we spend our time. But those accepted norms in other areas of the marketplace just don't exist in the sustainability markets yet. But we've got the opportunity to change, and I think there is. I describe myself as a repentant sinner to a large degree in terms of my 25 years of working within that business finance market, in terms of the attitudes that we've taken before, and it was that absolute need to do something to address the climate crisis and change the way in which business is working to a certain degree, is a key driver for us. That's our real ambition. We've got some wonderful things. So Future Leap has got its B Corp pending at the moment, and you've got such great things as the Better Business Act and the changes that they're asking to be made to corporate law with reference to directors' responsibilities to more than shareholder profits, which is starting to wheel its way through now at the moment. But unless we change some of the accepted attitudes within sustainability, and my colleagues here call it the deep greens, and so those which have been engaged within that sustainability bubble to a large degree for many years. How do we break out of that bubble? How do we stop taking the deep green attitude? The deep green attitude towards finance and capitalism and is challenging. But to make businesses sustainable, they have to be sustainable businesses, i.e. they have to be in existence, they have to make profit, not to be afraid of making profit, but it's what you do with those profits being the important thing, in order to change. We have to make the carbon reduction journey a strategic core principle of every SME business. It's not a nice to have anymore, it's a need to have. And regulation changes will be a key catalyst in that. But otherwise, we have to sell the business benefits to SME business owners, whether it be a cafe owner, a scaffolding company, or a law firm.
I think something that's really resonating with me with how you're positioning this is this whole kind of evidence-based approach, because if it is about the data, it is about the the conversations leading on to decisions that are evidence-based decisions. This isn't, even though I said earlier, it's kind of there is no real playbook to kind of work from. I think for lots of us, even if you're taking little steps and then you're evidencing those little steps, it does kind of inspire a bit more confidence, doesn't it, into somebody who may be looking to invest in your business, or maybe collaborate in a partnership, or if you then, as we're going to talk about in a moment, looking to potentially finance something that you're looking to do. If you have that evidence to back up where you've come from and actually where you're headed, it becomes less about this kind of unknown, well, I haven't really got any kind of evidence to sort of show, I just know it's a good thing. You've actually got something then that can allow you to forecast from a solid platform. That feels much more strong, doesn't it? Feels like a really good place to start.
Absolutely, 100%. So the learnings that we have from the consultancy team here at Future Leap, where they've engaged with businesses from small up to large and through into that public sector as well, is once they've done the carbon emission measurement from a 1, 2, and 3 perspective, a lot of the time, the first changes that are always made are those behavioural changes, the small changes, the things which can be done at low cost to the companies, but have an exponential impact to a large degree. And of course, it's those small changes, those behavioural changes, which can be made first. And then the experience that the consultancy team shares with me here is that then it's when we get into year 2 of the engagement, or even perhaps year 3. Well, that's where the company is now mature in its ESG strategy and what it wants to do, and has made those small behavioural changes and is now ready to make those investments. And yeah, the data-driven approach is absolutely the be-all and end-all carbon impact measurement. And so we're working on some really exciting tools in that regard. But yeah, if we can measure the impact effectively of the asset which is being installed, of the digital emissions which are byproducts of that, then we can do something. And the interesting thing is, when we look at those return on investment calculators, this is going back to some pretty straightforward methodology. It's what is my monthly cost compared to my monthly saving, which is where we've used a financing structure rather than having to capex the whole investments up front. And the simple methodology is, if we have a cash surplus at the end of the month after the investment we've made into our new technologies, then we're quid in, we're up. And we can't laud the high energy prices as anything but an absolute disaster. But with the high energy prices as they are now, and with Cornwall Insights telling us that those high energy prices will remain high for the next decade, well, we've got to do something with that in terms of what can we do to reduce those costs for business. And of course, if the impact of that, and if the side impact of that is that we've achieved a carbon reduction, well, a big proportion of the business owners will look at the cost saving first as the good thing rather than the carbon reduction. And so we don't care why they do it, as long as they do it.
And there's something refreshing about this kind of approach as well, isn't there? Because it feels really creative. I know, some people will say, "Oh yeah, finance has always been creative," but it really feels like a creative. I know it is a science as well, obviously, but it feels that there's a level of kind of really innovative thinking, creativity, you can really get quite excited by the opportunities here, can't you? And I think no matter which perspective you are, you might be a business owner, you could be a startup ecopreneur, you could be obviously finance director, but from whatever discipline you're coming from, there's something good to really buy into here, because this is almost a fresh new way of thinking about your business, isn't it? It is different than the old model of I've got to go and see my bank manager, or I've got to go and take out a big fat loan or something like that. This is different. This is kind of something that really gets intrinsically into the strategy of your business going forward.
Yeah, absolutely. I think the experience that we've had over the years is that a complementary third-party finance offer, now whether that be asset finance, whether it be business loans, will then support working capital within the business and senior debt and those debt facilities. Now we have to remember that the SME community is now burdened with a level of debt which is unforeseen to a certain degree post-pandemic, and so we've had SMEs have had to access the coronavirus business information loans, the C bills, the bounce back loans, the B bills, and the recovery loan scheme, those RLS. They've had to access debt in order to survive. But of course, debt has got to be paid back. It's that's by its very nature. And so they've accessed the debt, they survive. But now, when we're starting to look at service that, it starts to become more challenging. So therefore, approaching the bank becomes really problematical, because the bank is obviously covered with securities, typically from the directors personally, with debentures over the company, charges over property, and that type of thing. But they have a finite appetite in terms of what they'll lend. And when business owners in the SME community are servicing a high level of debt, well, taking those bank facilities and tying them up in assets and investments means that they will have a detrimental impact on the working capital that they can now address with the bank. And so it is a new-ish way of thinking, but certainly it complements what those business owners need to do, and it future-proofs their working capital facilities that they'll have with the bank. And so whether that's finance directors or managing directors, or making decisions about their own investments, but also for those companies which are taking these retrofits solutions to market, it's absolutely imperative that they're looking at ways in which they can help their customers to acquire those systems. And we have some wonderful options which are available, including structuring service agreements which have got embedded terms within them. We're supporting a company which is taking their product to market as a software as a service. So the customer is entering into a software as a service contract, but we've embedded the right terms within that contract so that our partner, the supplier of the software, benefits from a big capital injection at the start of the contract with the contract win. So, which means that the customer can achieve what they want to, the supplier can also achieve what they want to in terms of overcoming budgetary objections, but also benefiting from a big cash injection when they've won that customer, which is so important in terms of the growth of the company. If we look at the typical retrofit supplier as an example, we don't have huge balance sheets. We have small businesses which are growing, and the demand for the services which these retrofit suppliers is just extraordinary. We keep hearing that demand is outstripping to supply to a certain degree. So therefore, allowing these businesses to be able to access the cash from their commercial contract wins and send them on that growth trajectory is all important. So yes, there's lots of different ways of looking at it, but certainly, supporting businesses investing themselves or trying to help other business to invest is our core ambition.
Is there a kind of, and I suppose the answer sort of obviously in all senses is going to be yes, but I just wanted to kind of get down a little more granular level of detail. But is there a kind of almost an ideal kind of business that you'd look to work with? I'm just thinking that, if any business was aspiring to, open up all of their options in terms of financing and just really understand, okay, based on who we are, where we're going, we're purpose driven, very, got strong values, real sense of kind of, the data behind us. We know kind of, strategically what we're about. But how do we kind of set ourselves up to be attractive to Dan and the team is kind of what I'm thinking here. Is where would somebody start to really focus their attention, almost to prepare for those kinds of conversations?
I think, in answer to the first part of the question, the businesses that we engage with will be anything from micro businesses, and so at that small end of the SME scale, through to some substantial industrial companies, enterprise companies within the corporate space, and into the public sector as well. So all have slightly different requirements and what they need to address. But in terms of the typical audience, so if we think about supporting, the SMEs in Bristol first and foremost, and then further beyond that to the southwest and nationally as well. But Bristol being our first stage of attention, as it were. It is ensuring that the business is ready for debt. Because it's not always the right solution. It could be that when a business is very much in its infancy, it may be too early to find a debt solution. We have a range of lenders that we support, and so we are first and foremost a broker. And so when we're working directly, we're not a lender ourselves, and so we have been building a panel of lenders who will work with us based upon pledges around ESG, the way in which they will are treating ESG internally, but also remembering that for the business lenders, they're at the start of a journey here as well, in terms of their own ESG credentials, and so we're supporting that lending community. But what they can do in terms of impact lending from an environmental perspective, and from the investments or for the lending that they're making, we should help Triodos very much at the top of that tree as far as the banking community is concerned. But they're a wonderful organisation. But can Triodos support the SME community? Well, no, because they have an entry-level transaction size of around about 300,000. So we're working on a transaction at the moment. It's not a done deal by any stretch of the imagination, where we've managed to introduce Triodos into an independent lender who's got the service platform required to be able to take their net zero funding and distribute it into the SME community, which then brings us when we think about the ethical lenders that we want to work with, we've got the ESG credentials of Triodos at the top. So and now we're enabling them to take their funds to that SME community. But in that SME community, which is the real focus for us, being debt ready. And so we have a panel of lenders. If you think about the top end of the tier, those more established banking type organisations, you've got to have the balance sheet net worth, the financial net worth, to be able to access those funds. But they come at a very cheap cost of funds, which goes alongside that. When we're thinking about, and this is, sorry, going off on a tangent there, one of the things that we hear is that the funding available from a debt perspective into the sustainability community is expensive. Well, that's because of the way in which the lending community structure their pricing, and bad debt provision, the perceived risk associated with the transaction is probably going to be the biggest part of that. So we have to reduce that perceived risk as far as the lender's concerned. So there's always that funding available. We then have, at the other end of the scale, we support SWIG, and so SWIG Finance in the southwest is an awesome organisation, really good people there, and so they are a community development finance initiative, a CDFI, of which there are 55 CDFIs across the country who are lenders within the consumer world that will keep vulnerable individuals away from the payday loans and loan sharks. But there's a vast majority of those CDFIs support the business community, and they're very adept at lending from a social impact perspective, and they are themselves on the start of a journey about how they can become an environmental impact lender. And there is certainly that want to do that, because those regional CDFIs, the CDFIs typically support the regional, so Southwest Investment Group being SWIG, they will support the Southwest. So those regional lenders can then support the SME community where banks typically wouldn't lend. And those CDFIs are very cash flow driven. So cash flow forecasts moving forward, in terms of, okay, well, what's the investment for? What's the return on investment of that? And then these the CDFIs are typically looking for impact as well. What's the impact of your business going to be from an ESG perspective? When we go back to those UN sustainability goals in terms of reporting that. So if it's an impact business where the principals want to do the right things, if there is a solid business idea which investment is going to help to generate a return, and we can see from the cash flows that we've got return, a strong management team, and if they're new entrepreneurs, strong advisors to that management team, all make it a very doable deal. The CDFIs will underwrite this in the right way, and so the CDFIs also being very strong, along with another part of ours, which is the charity bank, in terms of supporting social enterprise and supporting those community interest companies, the CICs. Again, it's all about making sure that we can see the right return. What's the impact? And it does come down to cash, and so because lenders want to get that money back, but supporting those type of budding entrepreneurs, those types of social enterprises. And again, one of the things that we're more than happy to do is to support the clients in terms of making sure that they're packaging up the information in the right way, so that before it hits an underwriter, it's got its best chance of a yes, as opposed to putting something forward which underwriters will struggle to say yes to because it's not being packaged and presented in the right way. So, and part of that packaging is about the risks involved, and how those risks can be mitigated. But to give the businesses the best chance of success working with an organisation like us, but there are other brokers which exist as well, is going to help them to do that. And so yes, a long-winded answer, I apologise, but yeah, a whole range of different lending options depending on who the customer is. And so we as a business have decided to only work in the non-regulated space as far as the Financial Conduct Authority is concerned. So that's the limited companies, and so we don't support sole traders with transactions up to 25,000 because they are transactions which are regulated by the Consumer Credit Act, and so we've made that choice not to. So the limited companies is the entry level sort of anything apart from what could be deemed a consumer.
So it feels like there's a theme here in terms of what is attractive then, because one of the things you said a number of times then is you were describing the various levels and various types of organization that you support. It feels like those who are cash flow, let's say positive, but cash flow stable. Let's use that word just to kind of broaden it out a little bit. To be cash flow stable obviously means the obvious, but do you feel then, and I'm really interested in your personal take on this one, do you feel then that kind of circular business models then potentially are very attractive? And the reason I say this is because one of the interpretations of the whole idea of being a circular business is that you could potentially enter into some kind of subscription style way of doing business, rather than just constantly trying to sell product or service. You actually enter into a subscription style model, so you're buying effectively a much longer term customer relationship and serving appropriately with value, blah blah blah, all that kind of stuff. And I've been a huge advocate of this for a long time. As soon as I kind of got a sniff of this, I thought, well, what's not to like? It makes business predictable, it reduces risk, it keeps the customer happy because they're going to get a much more attention and hopefully higher value from the business they're doing business with. What's not to like? So surely this feels it's kind of aligned with what you're looking for as well, which is this kind of nice stable cash flow approach. So am I getting this right? Am I kind of reading this across into a finance perspective correctly?
Yeah, 100%. It is, again, taking the learnings that I've had from that technology marketplace and the servicisation, the subscription economy that has evolved there, brings with it some interesting models that can be applied to our sustainability industry and what we're doing. But the heart of what you're saying there is 100% right. Monthly recurring revenues, those MRRs, just give that business so much more of a comfort factor in terms of knowing that there's cash coming in. And again, if we look at the effect of the pandemic. It was those businesses which had strong monthly recurring revenues, MRRs, which thrived. For those businesses which were more transactional in their focus, they're the ones which were challenged. And so absolutely, and we are a firm believer in sustainability as a service, and being able to take the product on that basis. And as a team here at Future Leap, in terms of the consultancy leads that we've got, it's something that we're looking at. And so how can we minimize costs for the end customer in terms of their sustainability strategies, measurement, but give the biggest impact? And the way to do that is longer term commitments with monthly recurring revenues that go with that. But of course, that brings with it a challenge to the supply business in terms of, well, how can they grow? If they're building monthly recurring revenues, then it doesn't bring with it a huge amount of cash. It takes a while to reach that tipping point in terms of the cash that's coming in. So therefore, the application of finance products to support those subscriptions is all important, which is hence the monitoring company we spoke about earlier, where it works really well. We've actually launched another product which is very successful, and again has been taken from that technology market, which is subscription funding, which is the opportunity for the supply company, so the clean tech supplier, the green tech supplier, to engage with their customers on a monthly recurring revenue basis. But we have the ability to accelerate the first 12 months worth of MRR into that business. So they've got the best of both worlds, where they can take a simple service agreement to the customer, where we don't have to embed all sorts of complex terms into it. So a simple service agreement into their customer, which will allow them to engage and to benefit from the services without heavy cost and heavy capex requirements. But the clean tech supplier still gets that injection of cash on day one by utilising the product that we've put together. So it's that best of both worlds. And again, we've seen some really interesting applications of that for startup companies, where they can perhaps put pressure on their supply chain. If startup companies have got a considerable expense with a particular company where they have to engage on a monthly recurring revenue basis and pay that subscription, then we've got ways in which we can show them how we can help them to effectively inject cash into their business via that supply. And so the creativity and application is all important. But I would wholeheartedly agree with your thought process there, particularly in that circular economy. Monthly recurring revenues, the subscription economy and servitization is critical to success.
Wow, finance and marketing hand in hand on, who would have thought? Yes, it was never going to happen. No, it's happening here in front of our very eyes. And it just feels so positive, actually. And it's always, and again, from both perspectives, it's lovely for finance to have the marketing evidence and vice versa, because we're having the same kinds of conversations, just from a slightly different perspective. But if we're coming to the same end kind of decision and the same end result, well, what's not to like? That's great.
Oh, absolutely. And coming from a sales background myself, businesses buy on benefits. And so the key benefits that a business will buy on, we have three common factors across companies, whether they be large or small, which is profitability, revenue, and debtor days, how quickly you get cash in. And so if we as a finance team can put models together which support the marketing efforts which are trying to attract exactly the same thing ultimately, then it's got to be aligned and it's got to work.
Yeah, sounds a great way forward. Another thing that's a great way forward, I understand, is a new scheme that Future Leap is announcing shortly, has announced. It's coming, it's here. Is it? What is it? Green Loan Scheme.
Yeah, absolutely. So we are announcing shortly, and so within the next few weeks, a green loan scheme that we're delighted to be bringing to market, which is supported by one of our funding partners, who's made a 10 million fund available in order for us to take green loans to market to support businesses on their carbon reduction journey. So these are loans which are available for carbon reduction projects, and so they're not working capital loans. They are specifically for companies that want to invest. So we've chosen to take these funds to market on a loan basis as opposed to asset finance, due to trying to overcome complexities to support match funding, which is required from the grant providers, but also to overcome challenges with reference to tenants within the commercial premises. And so asset finance is largely dependent upon you owning the building that you're putting the retrofit technologies into, which causes challenges if you're a tenant with regards to landlord's permissions and access to property and all those types of things. So by taking these funds to market on a loan basis specifically for carbon reduction projects means that the customers we engage with can use them as match funding to support grant applications, and if their tenants can easily access the right technologies that they want to as a commercial enterprise to reduce their costs, and the landlord gets the benefit of the improvements to their building as well.
Yeah, this is it feels so timely as well. This is the kind of thing that I think, you know, many companies have probably been sort of almost waiting, even if they didn't realize they're waiting for this to kind of happen, because it's one of those almost low-hanging fruits, I guess, in terms of an initiative. You know, certainly a lot of the stuff that I know people listening to this will be tussling with is, where do I begin? And I think it is in that physicality of premises. It is in, as you describe it, the retrofit thing, rather than necessarily creating something brand new and innovative out of thin air as a project. It is kind of dealing with what you've already got. And I think this is going to be a really nice kind of, well, bridge building exercise for some organizations, where they can say, okay, we can now actually make a start. So no longer is this something of, you know, just our dreams. We can actually begin this process and begin our journey. And of course, then that has a spin-off benefit that you can then start to say, hey, we're actually making gains. You know, we're actually, our carbon footprint is coming down, and actually we are moving to becoming a more sustainable business. Whereas I think a lot of organizations, again, going back to this retrofit model, have been sort of almost dragging their heels because of the uncertainty of actually what to do first. But this feels like it opens up the opportunity of, look, just get in there, just get started. And if you apply for it and you're kind of eligible for it, you can almost begin straight away. Well, you're talking about within the next few weeks it can begin.
Oh, absolutely. And so we would always recommend a starting point being to engage with an accomplished firm of environmental consultants to support that measurement in terms of the emissions. And so getting to accurate data about scope 1 and scope 2, which is the emissions within a business that we can control ourselves, and then those scope 3 emissions being those emissions within the supply chain or within our customer base that we don't have no direct control over, but can certainly influence over. And there's far too much emphasis has been placed with reference to the scope 1 and 2, and not enough emphasis placed on scope 3. And when we look at some of the tech giants which are engaged within the space as well, the likes of Microsoft, accept that 90% of their emissions are scope 3, are outside of their control. So for businesses who are only measuring scope 1 and 2, we're not getting the full picture. We're not going to have the impact we need to. So engaging with a firm of accomplished environmental consultants to support that business in accurately measuring what their emissions are and where those emissions are coming from is all important, because where those emissions are coming from gives them those small wins, those easy wins with regards to behavioural changes and that type of thing, which means that companies can start making impact right away without the need of big investment. But certainly once they've made those changes, then yeah, we've got funds which are available for business owners that they know is not going to impact their ability to access working capital from the bank, is going to be able to give them the right return on investment. And so there are a few assets where there is a delayed payback because of the size of the capex requirement which is there. But for the typical assets which people are engaged with, then you're going to see a cash surplus in year one from making the investment. So it's if you're the sustainability lead with an SME that needs to convince the managing director or the finance director that action is needed, well, we can give them a cold hard business reason in terms of reducing their costs now because of the energy prices. But of course, to future-proof businesses, then this is going to be a need to have the right talent pool to be able to recruit from, to have the right customer pool to be able to sell to. Well, you're going to have the right ESG strategy. And our colleague here, Catherine Piper, uses a quote from Mark Carney that says that businesses which don't go on this, I'm paraphrasing, but businesses that don't go on this journey will go bankrupt. And so, yes, the catalysts for change and investment is already there. And the great news is that businesses can access funds from companies like ourselves to start that journey sooner rather than later.
Yeah, the time is now. I mean, it absolutely is. And I think, if you've been listening to this and you've been thinking, hold on a minute, I need to wake up to this now. We've been talking about this. I need to now make it happen. I mean, I'm going to, in the description for this particular episode, I'm going to put all the details about Future Leap Network, et cetera, et cetera. But from your perspective, Dan, where would somebody, if they are very serious about making this happen, like today, they want to get in touch, where would they focus in their attention with your team?
Oh, well, I would recommend going to the Future Leap website. So futureleap.co.uk. There are inquiry firms and contact us forms on there to reach out. As I said, we in the finance team work hand in hand with the consultancy team here in terms of engagement to make sure that we've got a joined up approach in terms of what's happening. And so the Business Future Leap as a sustainability network has been around since 2005 and has grown fantastic. We've got over 400 paying members in terms of the network, all of which are key sustainability champions, and so many different levels of expertise in some of the nuances in the different areas, where we've got a community where we can access information and knowledge really quickly and get people on the journey. So engaging with the consultancy team is probably the right way to start that journey, because they can support in terms of starting with there's a small investment which is required in terms of getting that report done, but the return on investment from that is absolutely huge.
Just really, if somebody's thinking about this, you just got to do it. You just got to make that connection and just begin the journey. It's the time is now, and with the green loan scheme coming up as well, you can get some quick returns. And I think for me, this is the thing. It comes back to the point about evidence. At the end of the day, this is about getting the evidence to build the confidence internally and with any partners and other consultants you're going to work with. And again, if there's finance involved later, everybody needs to be confident. So the confidence begins with people taking their first step. So thank you for that connection.
Absolutely, and I think so those which are still building their confidence up and taking those steps would recommend looking at joining the Future Leap Network, where we have regular events covering all areas of sustainability. And so it is a way to get involved with the community, to learn from others' journeys more than anything, and to see the support network that we've already got within the Southwest, in particular in Bristol. And so for anyone listening to pop into our co-working hub, which is genuinely carbon neutral, based on Gloucester Road in Bristol, to come in to see the thriving sustainability community that's being built there.
And to drink some of the amazing coffee, and the cakes in the cafe are just to die for as well. Always helps. Yeah, Dan, it's been a real pleasure. Thank you so much for your insights and wisdom as well here, because I think, for a lot of us to just get that clarity over, how to take these first finance steps, but actually how straightforward, when you listen to it, it is, and how it dovetails in with probably what a lot of us are already thinking. So you brought a lot of clarity, I think, to everybody here. So really, really appreciate your time today.
Absolute pleasure. Thank you.